Response. Hello all, I welcome you all for the informative session about algorithmic trading. My name is Akhil Tenwala and I am a Senior Program Manager at QuantInsti, which is a pioneer training institute in algorithmic trading training. I would like to introduce you all to our faculty and speaker, Mr. Nitesh Khandelwal, who is an IIT and IIL alumnus, who is also a co-founder at iRich Capital Advisory Private Limited as well as QuantInsti. He has a domain experience of about a decade in India as well as global markets. I would request Mr. Nitesh Khandelwal to take over from here.
Thank you, Akhil, for the kind introduction. Hello, everyone. This is Nitesh Khandelwal here, and we'll be covering this information session on algorithmic trading and also the EPAT program. So the agenda for today would be just to cover about what is basically the small basics of algorithmic trading, overview of the industry, the current market share, the growth and future of algorithmic trading, some of the risk measures and technology advancements, and also we would like to see how we can have the practical aspects of it, how to implement them with respect to the Indian as well as the global markets. We would also touch base upon what are the various aspects, the critical aspects of EPAT program, the evolution of the same, and how it can be relevant for most of the audience here. So to start with, what is algorithmic trading? So the algorithmic trading, if you look at the right, the Investopedia definition would be the algorithmic trading is the process of using computer programs to follow a defined set of instructions for placing a trade in order to generate profits, speed and frequency that is impossible for a human trader. So there is no particular definition of algorithmic trading, to be honest. So that's why I said that it's an Investopedia definition. You'll find a different one on Wikipedia, and in EPAT probably you will find a different definition. So what we basically break it down into is that algorithmic trading is more of automation and using statistical and mathematical inputs for devising the strategies. So a lot of people would say that, okay, if that person is using a black box, then it's algorithmic trading. Someone would say that if he is using complex mathematical programs, then he is doing algorithmic trading. Everyone is correct. It's just that the key aspects of the key aspect of algorithmic trading is automation. So what you're doing is that you're automating the flow of the strategy development as well as the strategy implementation. So we break it down into multiple aspects. One would be like over here we have written like technology. So technology automation, using technology for automation. The importance of infrastructure, which is much more significant into algorithmic trading as compared to a conventional trading system. The strategy related aspects, so which would include the strategy ideation to modeling to optimization to the strategy execution, and also the risk management system, which is automated in case of algorithmic trading. So let's delve a bit more about each of these aspects on how it becomes important, or how they are related to algorithmic trading in general. So as you have understood now that algorithmic trading is primarily automating the whole strategy modeling as well as the strategy implementation process. So if I'm using within algorithmic trading, you will see that some of the strategies are quantitative oriented. Some of the strategies you will see they are high frequency in nature. So all these are terms which are primarily, you can say, are subsets of algorithmic trading, in which you might have some strategies which are of quantitative origin. In that case, in which case you will be using statistics. primarily for your trading systems, and some of them would be, say, plain vanilla technology arbitrage like latency arbitrage, where you are doing an arbitrage between multiple trading destinations. So say for example, trading between say CME and LME, for example, right? So over there, there is not much of stats maybe if you're doing it across the same instruments, but it can be a pure technology game where whoever is the fastest just wins the race, right? So that would be a pure arbitrage or technology-oriented arbitrage strategy. Similarly, there can be quantitative trading strategies which you have automated, which might not be just the speed game, but a mix of all these things together. And that is what we focus on, and that is what we normally on our side cover as the algorithmic trading, where it is important to have a good technology, it is important to have a good infrastructure, it is important to have a good strategy flow and a strategy idea, and it is important to have a great execution as well as the risk management system. I would like to spend a minute on the risk management system here, because risk management system is something which is the only thing that makes money for you in the end, and that is true. That has been true for like probably I think for the centuries now, where you would be right sometime, you would be wrong sometime, but in the end it's your risk management which will effectively make you money, right? So when you're wrong, you should not be wrong a lot, so your risk management should control that. And when you're right, you should be able to write, and you should not be throwing away whatever you have made during the process. So all these things which some people can also put that some part of it into portfolio management, but we try to put the whole gamut into the risk management system itself. Now, within risk management, now if you look at it from the algorithmic trading perspective, it's slightly different as compared to conventional trading system, where you will be facing or rather the focus is on controlling or mitigating the market risk. In case of algorithmic trading, the idea is not as much on the mitigation of market risk as much on the operational risk, because in conventional trading systems you have manual trader. The manual trader means human, the human means common sense, right? So that person who is sitting on the trading desk has some common sense, but when it is a machine which is deciding everything, then it has that much common sense that you provide it with, right? So that much that you have coded in the machine. So that's why it becomes very important that if a line is broken or if some data is not coming right, then you have automated safeguards which will stop the machine itself without any human intervention itself. So that's why we need to have an automated RMS as well. All right, so let's look at the slight evolution, and let's try to start from a much broader theme. So this is basically, we have tried to come up with how the technology has evolved over the time and how it has impacted various industries. So over here, if you'll see, it's the automobile industry which has changed from the shop floor where you had hundreds or thousands of workers, factory workers who were working, and which were replaced by giant robots over the century. Then you had computing revolution, where you had the movement from calculators, or before that probably abacus. So from there we had now computers which can do a lot of things within a minute's time, or rather within microseconds, which we would have tried to do in probably minutes using calculators, or probably a lot of things that you could not have done. Similarly, the smartphones, you can see this is all the things which are now probably 25 years back. You need a separate gramophone, a separate speaker, a camera, a computer, all of those things which are now covered within this small piece of device which is your smartphone, right? So this is just to give you an idea of how the industry has changed, or rather how the technology has changed the various industries. And same is true for the trading industry as well, where we have come from the trading pits where we had something like this till few decades back to something like this. So this is essentially a new age trading pit, right? So where you do not have a lot of hue and cry, you do not have emotions running up and down, and you just have machines which with a silent, as much silence as possible, maybe excuse the buzz a bit. So the buzz of the servers in the data centers or in the co-location facilities. But this does as much trades, or probably 1,000 times more trades, as a the most busiest pit, which used to do probably 25 years back, till 25 to 30 years back. So this has been the move. So the idea of this is to show you that algorithmic trading is not something unique. It is something it is some change which technology has brought across all industries, and same is true for the algorithmic trading. One parallel that a lot of people draw, or a lot of people at times actually complain, is algorithmic trading is causing people losing jobs, or the manual traders going out of business, or more efficient people winning the game. So now the thing is that the same thing happened in each and every industry. Wherever, so say there was an industry giant called Nokia here, right? So I don't know if what is the market share now of Nokia, but post the invention of the smartphones, I think that just dropped probably just a fraction of what they used to have. Right. So similarly, in automobiles also, the Japanese car makers or the German car makers who came up on top and trumped a lot of other developed market automobile industry. So it just happened because they endorsed the technology, they endorsed the change, and tried to learn the new skills, innovated, and also while learning those skills, they also put the focus on implementation. Right. So same thing has been happening over the past decade, especially in the trading side as well. And it is not just limited to the developed markets now. It is there in almost all the leading markets, be it emerging markets as well as the developed markets. So this will give you some idea about how much it has taken. These are from different years, so don't put me on these numbers, but these are all from the exchanges websites. So you can see that in CME, these are all the top top future contracts, where you will see it's between 35 to 70%. That is the volume of algorithmic trading of the overall volume. This is the traded volume. Which we see. Similarly, MCX, which is Multi-Commodity Exchange of India, the biggest commodities exchange in India. You can see these are the top contracts which are most traded in terms of volume, in terms of value, traded value, and you can see it is again 25 to 35 or 40% of the total volume is through algorithmic trading. So please note that in India, this is something which happened only post April 2008. So this industry is like probably 8 years old, and in 8 years we are seeing, even in the commodities market, where you see a lot of participation from the retail players as well as from the probably non-sophisticated players. We are seeing the algorithmic trading percentage volume of almost 35 to 40% in some of the biggest most traded counters. Similarly, NSE, National Stock Exchange of India, which is the biggest stock exchange in India, you can see that the cash segment is almost 44% of the overall volume, and futures and option segment, which is the derivative segment, it's almost 45% of the volume. Of the total volume is through algorithmic trading. So it's just to tell you that the algorithmic trading is something which has fast caught up caught up the developed markets in the emerging markets as well. So we started with zero. Within 8 years, you see almost half the volume being taken over by the algorithmic trading, and this includes a huge amount of HFT volume as well as the medium frequency trading volume as well. The numbers are even more interesting for the US equities, where in some of the exchanges it goes up to like 80 to 85%. So I have not included all the numbers here. This was just to give you an idea, but that's where we estimate that all the volumes would be going towards to. And it's not like it's a replacement volume, but it's more of an additional volume which has been created over the period of time, as the volume have risen over the decades, and with the advent of technology, the volume has just spiked up a lot more. So this is happening, and the cause of this happening, or the effect of this happening, is also that the trading infrastructure spending has increased a lot. So we don't have the latest numbers, but we do have an estimate that these numbers have risen even more now. This is something. So in 2006 to 2010, these are $4 billion to almost $8 billion. So within 5 years, the infrastructure spending has doubled, and this is only on the market data infrastructure. This is not all the technology infrastructure that automated trading firms or the overall trading firms have been doing, but this is only only for the market data infrastructure itself. And you can see that the notional values have been increasing in every market, be it US, which is in yellow, or in Europe in green, or in the Asia Pacific. But you can see that in Asia Pacific, it is also growing really fast. So maybe you might not see that much growth in the Europe area, which has been seeing a lot of curtails in the past 5 to 8 years. We have seen a lot of developments which are against HFT industry there, but still it has been growing, and not just growing, but the growth rate is also positive. Over here, the growth rate is also growing, and growth rate is growing really fast in case of Asia Pacific. So where you had, so the reason is also very much there. So like in India, it only started in 2008. Right. Similarly, in Thailand, Malaysia, all these exchanges, there also algorithmic trading is a more recent phenomena. So all those volumes are catching up, or the contributions which you are seeing in like in India, within 8 years we had 50% of the Indian volume, trading volume, being acknowledged to algorithmic trading. So that is contributing, and that is the contribution that you can see where you see this much of this huge amount of growth in the industry. Now, this is just about market data. There are a lot of other things on which people have been spending. So where else are they spending? So one would be simply co-location in data centers. So just to understand what exactly is co-location or what is a data center. So data center is somewhere, so over here what you were seeing, so this is nothing but a data center or a co-location facility where you have huge amount of machines, huge amount of servers which are lying over there, and they are making all the trading decisions. So everything, all the complex event processing, everything has already been coded into, and whenever based on the market data, the changing market data, they are making their decisions. Now, why do you put your machines in data center? Because over here in the say in your office, there can be some fluctuations, power fluctuations. The server performance might not be the most optimized performance, but in data center they take care of all those things to the extent of maintaining the temperature which is conducive for the highest or most optimized performance of the servers differently on the floor of the data center and the ceiling of the data center, right? So which is there, and then you have a specific kind of data center which is called co-location facility, where you also try to control the latency, which is the time it is taking to for the market data to reach from the exchange to you, or from for your order to reach from your machine to the exchange. So to reduce that, what you would do is that you would put your server directly into the exchange, which is called co-location. So not just putting into the exchange, but you are actually putting it on the same local area network, same LAN as of the exchange, where you have the matching engine. So the time it takes to reach the exchange reduces from probably say if you are far off, say if I'm sending an order from Mumbai to somewhere in Chicago, probably I'll be taking about 80 to 100 or 110 to 120 milliseconds. But if I am sitting in Aurora, the CME co-location facility in Chicago, then it will probably be taking less than a millisecond, right? So that is why people go for co-locations if you're latency sensitive, if your strategies need that kind of speed, and for that obviously you have to pay. So it's not like it would be available for you for free, because obviously these things need a lot of expense both for the maintenance as well as for the creation. So that's there, and then you also have, then that's for the co-location and data centers. Then you also have certain trading lines where you have to spend a lot. Now trading lines, there are two different, so from the perspective of connectivity, there are two parts in which you can break it down into. One is the connectivity which is for the trading, so with the lines which are directly connected to the exchanges, trading facility or matching engines, right? So what happens is that the more the bandwidth you have, more are the number of orders that you can send within a second to the exchange, which is again regulated by a lot of other things also, and differs from exchange to exchange. But in case of trading lease lines. You can have, like in India, you have for the stock exchanges, you can send up to 400 messages within a second, right? In case of CME, I think the limit is more like 1500 messages within 2 or 3 second window. So everyone has every exchange would have a different way of calculating it or implementing it, but the more bandwidth you have, the more orders or more number of orders you would be able to send. Then another part would be you can have the inter-destination lines, so which is same as having inter-exchange lines. So in this case, what you are trying to minimize is, say if I'm doing an arbitrage between, as I said initially, between say CME and LME, and say on the gold contract or some contract which has almost the same specification on both exchanges and can classify as a classical arbitrage. So for that, what I would need is, I would need to be the fastest guy in for doing that arbitrage, right? Or you can take example of 12 different equity exchanges in US, right? So you have in US you have a lot of different equity exchanges. So you might want to connect, you might want to do an arbitrage between two exchanges, say NYSE and say some other, say if you include the dark pools as well, then say for example BATS. So there are more than 12 dark pools as well. Then there are more than 12 equity exchanges in US. So if you're connected between the two exchanges and you have the fastest connectivity line, in that case you would be able to, you would be the first one to get the execution, to get the perfect, almost perfect execution, which the slower guy might not be able to have. So this is one area where a lot of expenses have been incurred by various trading players, and the technology has been rising really fast on this side. So it all started with where you would connect using VSATs maybe, using the satellites, and then it moved on to lease lines where you have point-to-point connectivity using fiber. Then it moved on to micro frequency, which is the relatively new technology which has been used for trading, and then now it is moving more towards the laser side, so which is even more expensive. So every time you move up the ladder, the technology cost keeps on going down, but the latest technology cost would be even more expensive because the amount of money that you can make is also much higher if you do it right. So that's one area where you would see that the expenses might be even more than what you will be seeing at the market data infrastructure, or it might be included in this part as well. Then you have for the technology development, where a lot of spending has been done. So this part is more from the perspective of reducing the system latency. So the earlier latency that we were discussing was part of more of transition latency or transmission latency, or the network latency. So which was because of the distance that is there between the between your server and the exchange, right? In this case, your server is already in the exchange, so there is nothing else that you can reduce on that side. Maybe some more tweaks, but it's more to do with how you are decoding the exchange packets that exchange is sending you, and how fast are you decoding them, and how fast you are putting your instructions. So basically, whatever, say if you're doing a moving average crossover trading strategy, then how quickly are you calculating the moving average, how quickly you are sending out the order, and then how quickly you are converting that order into something that exchange would understand using your OMS, auto management system, and sending it out, right? So all these things come into the technology development. Over here, what has happened is that earlier, so FIX protocol is the most common one, of course, Financial Information Exchange. It's like for the standards, you have ISO, International Standards Organization benchmark. Similarly, in technology, in the exchange connectivity, you have FIX, Financial Information Exchange, which is something similar. So you can connect using that, or you can connect using the native APIs of the exchanges. Whatever you do, you were doing it on the software side. So you're creating a software and using it for connecting to the to the exchange, right? Now, the software itself has some latency. So what people have done, or more recently what has been happening, is that you put the whole thing into the chip itself. So instead of coding on an operating system which introduces its own latency, you are coding on the chip itself. So as soon as it hits your network, the hardware, the chips that you have, microcontrollers, or the chips that you have, they themselves make the decisions and send out the orders, which we called FPGA, Field Programmable Gateway Area. So those those who are from the technology background or the electronics background might appreciate their lab experiments using FPGA, but now this is something which has been actively used in the algorithmic trading world, especially in the developed markets. So as we go down from the transmission latency to network latency to the system latency, the extent of the latency that you're reducing keeps on reducing drastically. So in the case of transmission latency, we were talking about saving 100 milliseconds, right? In case of network latency, probably we will be saving maybe half a millisecond or two or few hundred microseconds. In case of over here, when we are introducing these FPGA solutions and all, so we are talking in single digit microseconds. And then there are solutions which bring it down even lower. So that is the extent, and it might be counterintuitive to understand, but the lesser you are trying to reduce the latency, as in the more you have reduced already, and every incremental reduction in latency that you're trying to make, that actually the cost of doing that increases exponentially. So probably to save the transmission latency, you just need to put your server into the exchange. Say for example, in India, it would cost you around 10 to 15,000 US dollars a year for a complete rack. In say the US, say for example CME, it will cost you probably somewhere around 12 to 15,000 dollars a month. But to get an FPGA solution, you're again talking about few $100,000 at least to get the solution. And then when you talk about the inter-destination lines, if you go ahead and get a microwave frequency line, in that case, or connectivity, in that case, you're talking about probably a few $100,000 a month. So which depends on the distance and a lot of other things, but the cost increases exponentially. That's what we are trying to make the point. And then a lot of expenses which are going into the salaries, right? So the salaries is something which have been rising massively in this domain, and that's true not just for the developed markets but for the emerging markets as well. So when it all started, say for in India, you didn't really had a lot of PhDs or from the Ivy League technology schools, or PhDs in maths, physics, or market microstructure coming into the market. But as the market size grew, all these people also came in, joined the bandwagon. Not as much in India, but say definitely in the developed markets, which obviously drove up the costs which are there, the salaries which have grown multifold within last decade, actually much more than twice or thrice, actually much more than that. So, but that is again a big spending which has been incurred by a lot of firms, which in the algorithmic trading domain. So now, so for all these people who are moving into this industry, what is the major change which is happening? So this is just a skill set overview. I've tried to keep it as concise as possible, but you can see that the number crunching, on the left hand side you can see the conventional trading success recipe, so which you will have, which probably included number crunching and patterns. So you had a lot of dealers and a lot of people who would look at the patterns, who would just watch the ticker, right? So people used to trade tickers till those who might have read reminiscences of a stock operator, you would remember that he just used to look at the tickers and try to make sense of that and trade using that. Then came the electronic trading, so where you were still doing manual trading manually, but out of the pits, not out of the pits, but rather inside your office, and just by typing up the orders. So how fast you're entering your order, that actually became a big skill in the absence of automated trading systems, or because of regulations or technology, whichever way it be. But you would see that those who can send an order in a second, or probably 2 orders in a second, they would become a costly resource by themselves, especially on the dealer side. Again, the reference in this case you might remember would be the Wall Street, where there was a dealer who could execute as many orders as possible at the instructions of Michael Douglas in that movie, and he will just make a huge money, right? So that was actually a skill set which was highly valued. And then the financial markets understanding, which remains true even till that date. So the financial markets, you have to have a clear understanding of what is going on in the market, what kind of so basically all the basics of the market, be it on the market microstructure side or be it on the various trading strategy side, or understanding of how stocks trade. So like even understanding how the dividend play happens, that would have a max impact on how you trade even complex instruments or newer instruments like options, right? So that's there. And then there was something called connections. So you could not learn all these things on your own. It was really difficult. You need to know someone. You need to have some connection to enter into that trading pit, because it was a small area, right? And not everyone would be allowed into that because it's a small area again. So the real estate is limited. So the space is limited, and that's why you would need people to actually get an entry into that pit, or to get an if you want to learn about it, you need to know someone, because there's not enough text or enough literature which was freely available. Obviously, the internet was not that active a few decades back. So these were all the skill sets which were would have made you a happy and a successful trader till few decades back. What has changed over time? If we look at the trading success recipe for the quantitative trader, especially in the contemporary trading world now, you'll see that first and foremost, a very good understanding of mathematical and statistical understanding. So this is something that you need. You need to understand the mathematics, the statistics, which you can use for strategy ideation, for strategy modeling, for strategy implementation. So we'll be at the end of this session, we'll try to do a case study, small case study. I will discuss on it and see how all these things actually make a move into your overall strategy development, as well as your implementation plan when you go for a quantitative trading or algorithmic trading implementation. Then, so mathematical and statistical understanding, this acts as a building block for your strategy. Then you have financial computing. So this is the toolbox. So the toolbox which can include your R language, which is open source and heavily used by the hedge funds as well as the algorithmic trading firms globally, big and small alike, and or Python or other programming languages like C, C++, .NET, all of them. Right, so this parts Excel, VBA, even basic things like that. So all those things comes into the financial computing part. And then you need to have the understanding of, because this financial computing is important from the perspective of you will be dealing with a lot of data. You will be dealing with, like, probably on a daily basis gigabytes of data. So for that you need some sophisticated tools to use those to make sense of that data, to analyze that data. And then also when you want to automate the execution, you need a programming language using which you would be able to code that up, right? So that's where the financial computing comes into the play. Then you need to have a very good understanding of technology and market microstructure. Why do I need to understand technology when I'm going to trade, and how does it matter? Well, it turns out that it does matter a bit, if not a lot, even if you have a lot of technology resources at your expense. And that is from two reasons. First is it will shorten your go-to-market. So there would be less communication gap, so the mishaps would be less. So what you are telling the other technology guy to code up in the strategy, if so the technology, either you're assuming that the technology guy already understands everything in the financial markets or the trading side, which is as good as saying that you understand the technology as a trader, right? So if that is not there, in that case there can be a huge misfit in the company, or the gap in communication which can happen between the trader and the technocrat. And we have seen these things happening with our earlier consulting during our earlier consulting assignments, or during our interactions with different trading desks, where the traders who did not have any idea about technology, they could not communicate. They were not able to put themselves into the shoes of the technocrat, and it will just keep on expanding the go to market a lot, right? That's one. Now, second is a more important one to a lot of traders who value their IP, is that you would not like to disclose each and everything to your to anyone else, probably, right? So if you do not want to disclose, so you would always like to keep one part of the secret sauce to yourself. And to do that, if you're automating the whole thing, you would need to understand a bit of programming, bit of coding, so that you can do it yourself. So these are two primary reasons. And then if you're understanding the technology, then it makes your strategy analysis much easier as well, especially if you're doing it on the high frequency trading side. So it would make your life easier if you know that 400 message per second is the limit on the exchange side. If you know that, then it would help you, which can also be included as the part of the market microstructure. Or if you know that what are the pitfalls that can be there because of the technology in your strategy, you can try to mitigate those risks, as well as take advantage of those things in your strategy as a trader. And then the financial market understanding, which remains the same as earlier, just that now you need to have not just the understanding of the basic stocks or commodities or futures, but also options. And those of you who trade into CFDs and other things, you need to have a good understanding of all those more complex instruments as well. So that's for your quantitative trading success recipe, which you will have. And these are the opportunities. So I've just tried to create a pie chart, which I just got from my placement, from our placement cell, and on how the various openings have been. So instead of going to the market or some research group, this is our in-house data, right? So we see that the openings in the industry, these are more from the India perspective. So the openings have been widespread across various domains, but primarily into, you can see, the trading, so which would be low frequency traders and high frequency traders, quant algo traders, quant analysts, the quant developer and programmers, which makes up for the bulk of the overall, or head algo risk or derivatives equities trader. So this makes for the bulk of the overall openings which we get. So we have got in the past few years, we must have received hundreds and hundreds of various openings, and these are all the live openings which we even have even right now, so which would be probably dozens, probably maybe 50 or something between 50 to 100 possibly. So these things, this is just to give you an idea that how different opportunities have been there. It's not just the people who are looking for a trader, or just someone for the research, or someone for the technology, but it's a mix. It's a big mix. And if you understand the basics of each and everything, for each of these profiles, I can tell you that if you only know technology, then you cannot actually go into quant developer or programmer. You need to understand more than technology. You need to understand a bit about the markets, as well as you need to understand a bit about the stats part as well, probably. Right. So this is there. So this is where we come into the EPAT part, so which is Executive Program in Algorithmic Trading, which is QuantInsti's flagship program, and is one of the first programs across Asia Pacific for which is dedicated on learning in algorithmic trading. It has evolved over time. It is now a 6 months long online program, which includes 2 months of course project work, which can be linked to the industry as well, depending on the scope of the project and the participants. It has more than 100 hours of live interactive lectures. It has 200 hours of additional coursework. We have the experts from all across the industry and professionals who have been teaching as faculty for QuantInsti are on our faculty panels, which has truly totally gone global now. It's all started with probably 5 or 6 of us who started, and now we have more than 12 to 15 faculty members, and including the biggest names in the industry who are there in taking the sessions and adding value to all our EPAT participants. And it was when we started, it was a classroom program, so it was only limited to the place, one city. But as we evolved for past 4 years, it has been a online program which can be done by sitting anywhere in the world, and which can be conducted by anyone sitting anywhere in the world as well. So I have myself taken classes from Mumbai, as well as Singapore, as well as some other locations as well, and it makes so much more sense to have it online, which was only possible thanks to the edutech industry, which has grown a lot in the past decade. But what it has also helped us is in creating a learning management system which is available to our participants 24/7 access throughout their course program, where they have all the recordings of their lectures as well as the assignments, as well as the quizzes and primer material. Everything is there, right? And then we also have a dedicated support team for the quick query resolution, which is part of the EPAT program. So this is, here we cover, so like the key salient features of EPAT would be the practical exposure. So this program is oriented towards working professionals who want to adopt or who want to move into the algorithmic trading side or algorithmic or quantitative trading side. So it's very important for us that we cover the parts which we believe are practical in nature, so that once you learn the anything that you're learning in the program, you should be able to go and implement that into the program as well. Then you have domain experts and support. So as a faculty, so the EPAT faculty, we are almost everyone of all of us are practitioners here who have actually gone out and traded in the market, as well as even are part of the algorithmic trading industry as traders or as leads or whichever way we are. But even the external faculties, they have their own hedge funds or they have their own groups of trading. So it's all practitioners. So you are never disconnected from the industry, the reality of the industry, which can happen in at times in a degree program or in a theoretically oriented program. And to make sure that we have the connect with the industry, we have the dedicated career services. Like I told you earlier, we had this placement cell where we reach out to various placement to various corporates. We have link ups with them and who know that we have the best of the lot in terms of the skills that are required in the industry in algorithmic or quantitative trading side. So who keeps us inundated with various openings which have come on their side. So that's a dedicated cell which not only serves to our participants but also to all our alumni. It's a certificate-based program which is provided by QuantInsti itself, and we have all the lectures that they are live, and also it's not just something where it's not like this session where we are just I'm just speaking and you're listening, but it's also we have more hands-on sessions. Most of the sessions are hands-on where you're actually doing and learning by doing that, right? So that's always there. So this is the overall curriculum. This is statistics and econometrics, quantitative trading strategies, financial computing. Now in statistics and econometrics, as I said, it's more of building blocks which are there. It involves some amount of theory as well, which is more of a necessary evil, because if you don't know any theory at all, then you do not know what you will be implementing, right? So a basic theory is required, but our approach to theory is more from the perspective of, say, for example, if I'm discussing derivatives option pricing module with you, in that case, the idea is not to go through the detailed derivation of the formula, but more from the perspective of how you will be using that formula when you go out and trade in the real world or go out and analyze your models in the real world. Right, so not to say that we do not provide you or help you in the derivations. If you want to, we can. We do have a study material which is linked to that, but that's not the part of the core EPAT program as such. The core EPAT is focused more on the practical learning side. Then you have ATP, the financial computing module, where you have ATP's algorithmic trading platform module, where we use multiple platforms. So this is also something which has evolved. We'll covering that on the next slide. It involves more of R and Python and Excel in the current state. And then we have the quantitative trading strategies, where this is also one module which keeps on evolving. It has some core modules which includes statistical arbitrage or the options Greeks trading or machine learning oriented trading strategies or artificial intelligence based trading strategies. And then also you have market making strategies and trend following strategies. All of those different kind of strategies are included in this domain, and also how you use Greeks for your risk management, which is part of the ODR, which is option derivatives and risks, and also the business environment side, where we discuss on how you would be, how if you want to set up your own desk, how you are going to do that, right? How the real thing or the real business side, apart from the strategy and the technology, which is on the business side, right? So so how if you want to go and take a membership, how would you doing that? So those things are also included as a module, which is on the business environment, part of the quantitative trading strategies module. And then we have obviously a list of different strategy paradigms which are covered. And yeah, and this keeps on changing as per the industry. So like earlier we had so like at this point, if you'll see, new methodologies, ML, which is machine learning, now forms 8% of EPAT. It started with just 2%, right? So it has evolved over time, and I think it's even more than 8% in the from the coming batch. There are more sessions which are being added, which will be taken by TAD as the faculty, and it's just that the industry is growing towards that side. The machine learning is becoming more of a more and more a key thing into the on the trading side. So we are also expanding our forte or our module depth into that into those parts. So it's a ever evolving curriculum for the high frequency industry, right? So because it's not to say that by high frequency I do not mean high frequency trading here, but it certainly is something which keeps changing very fast. That overall trading domain, even in India itself, we since 2000, if you look at 2000, there were no futures, no options. In 2000, by 2004, there were futures as well as options. By 2008, there were currency futures and currency options. By 2009, you had co-locations and tick by tick data. So it all keeps changing really fast. And even if I list down the things which have happened within the last 1 year in any country in the algorithmic trading world, you will see that so many changes, or not just algorithmic trading, actually overall trading. So you'll see so many changes, and which means that the curriculum has to keep on evolving. And we are happy to have the pedagogy experts on in our team, as well as the domain experts in our team, who make sure that that we are always, the curriculum is always relevant, as well as, or not just relevant, the most relevant for the industry requirements across the globe. So which what happened is very recently we moved from C++ to Python. So the reason being, the Python is something which is picking up really fast across the globe. So earlier it was just C++. The primary reason was it was mostly the institutions who were doing the algorithmic trading as such. It was not the retail players. But as soon as it came to retail players or the individual professional traders who wanted to trade using algorithms, you will see that C++ based algorithmic trading platforms, they were not really that much affordable for them, or not really in sync with the requirements. Right, so these are people who have more interest on the medium frequency or medium latency sensitive strategies rather than low latency trading strategies. So Python has been picking up really fast in the across the globe, be it in US or in European markets, or even now in Indian markets. We are seeing a rapid movement of Python, or rapid adoption of Python by various market participants. And that's why we also we don't just look at the what is happening real time, but we also try to see and predict that what will be happening over probably say next few years, how the trend would be. And given our industry experience, we have been able to make the right moves there. So that's why we moved from C++ to Python. We moved from institutional trading platforms to more affordable platforms, which can be used by various so like by individual traders as well, not just the institutional players. So right now we cover Quantopian. We cover on the Quantopian, which is those who want to trade into US equities. It's a very easy platform to use. If you know Python, that's good enough. If you know Python, if you know Zipline package, you are as good as ready to go and trade on that, if you have the strategies and all those things. And it's a web-based platform, and free of cost, right? So it's just the brokerage that you have to pay using, say, whether it be Robinhood or whether it be interactive brokers that you can use for trading. Beyond that, then we also have for the other markets, so we understand that it's only for the US equities that Quantopian is there. We have interactive brokers, and we have the interactive brokers Python API, which is covered in the program. So to make sure that So interactive brokers obviously have a massive reach across the globe in terms of access to markets, and that has helped a lot of our participants to actually go out and connect to the relevant or their desired markets using interactive brokers API. So that is also covered. So that again is something which you only pay the brokerage, but not really the any fees for the platform, right? Then similarly, we have for those who want to set up their own desk or who want to trade under their own membership, we have a list of memberships, which list of vendors, platform vendors, both affordable as well as premium, who can help you in getting up to speed from the technology or infrastructure side. Then there are so many retail or individual traders who want to do high frequency trading. They don't want to just limit themselves to medium frequency or low frequency trading. So for that also we are always in a lookout for reaching out to broker partners who can provide those services to those individuals. So for our participants and alumni, where they can go and join those brokers as an individual trader or as an employee, whatever way they want to be, and use whichever platform they want to, right? So both for HFT as well as LFT. Then we have been using new methodologies which keeps on getting adopted. So like as I said, machine learning forms now 8% of EPAT, probably more now. And these are all changes which has been done probably this year itself or maybe in 6 months duration. The new strategies, inclusion of machine, like we are contemplating including machine readable news or the sentiment analysis based strategies, which we expect them to be adopted from the coming batch itself. And interesting part is that we have always tried and made sure that all these changes are accompanied by inclusion of industry experts. So when we moved from C++ to Python, so we have the in-house capabilities, but we still made sure that we had Dr. Eve Hilpish come and take that program, take that module for a part of the module for us, so that he can share his own pedagogy experience of Python for Finance. So like he is also the author for Python for Finance book itself, which is quite a bestseller in the academic world. So how those changes helped us to make sure that the transitions were smooth and they were well appreciated by our audience. So that is one key thing that we always make sure that we have ever evolving list of industry experts joining us. So for the relevant modules, and especially at the changes of at the time of changes, we make sure that it does happen. This is just a brief list of modules. Of course, if those of you who are in touch with our sales team or with my colleagues, they would have much more detailed list of these modules, which includes primer, introduction, statistics with Excel, then R, Python, ODR, as well as various quantitative trading strategies. We cover 8 to 10 different trading strategy paradigms here. Business environment and the algorithmic trading platform, where we also connect to the simulator and you actually try to create your model and trade them against the simulator. And it is all capped by a project, so which is so we provide you with a list of topics that you can take project into, but it is not necessary to be limited to that list. So, but in that list, we provide you with a complete framework that how you can go ahead on that project. But if you want to, so it's basically a kind of a specialization, because we are trying to cover all these things within a brief period of 6 months, right? So at times you might feel that, okay, I would like to spend much more time or more in depth into this particular domain, which is of relevance or to interest to me. So you can pick that thing as a project, and you are, as soon as you pick the project, you are assigned a dedicated mentor who helps you throughout, who becomes your mentor for the course as well, not just the project. And you are in touch with him or her throughout your project cycle. So that's and that person is the industry expert or the domain expert within the, based on the topic that you have picked for that. Those who are not able to, so this is a compulsory requirement, but those who are not able to provide their full time, we also have option of providing you with a final exam, which you can take to get the certificate. So which is an online exam which you can take from anywhere, but it's a quite a comprehensive exam as well. So this is all these things have benefited lots of people, hundreds and probably thousands of people across the globe. We have covered probably 25 to 30 countries so far in terms of alumni or reach in with our alumni. Um, It's all over actually. It's all over. We have the only place remaining is Antarctica. I hope some researchers sometime in future he's interested in algorithmic trading and he does a course on Antarctica and we will be able to mark that continent as well. But now, for now, I think we have a wide reach in terms of the alumni base that we have, and not just in terms of geographies, but also the academic discipline. We have people from across different academic background as well as occupation, from hedge fund managers to traders to owners of the brokerage firms, the quant professionals, the people from the stock exchanges, consultants, risk manager, everyone. So it's quite a wide range. In fact, we had people who the ex-army person. There was this guy who from Germany who had 10 or 12 years of experience work as in the German army, but done the program. So it's quite a very wide range of domain that we have in terms of the participants or the alumni that we have had so far. And these are all the companies. These are a list of, I think, 42 companies. Probably this list might already be 45 to 50 already. This covers all the big names in across Asia as well as also in the US and UK, where we have a lot of big, huge alumni base. So that's there. Now I wanted to cover a quick case study in terms of how all these domains actually match up, or how all these modules actually come together to for a fine output. So I thought that I'll just pick a strategy like statistical arbitrage, which is a very old strategy, but is also one of the most researched strategies, and also one of the strategies in which a lot of people, huge amount of people have made a lot of money right from 1985 when they all started with Nunzio Tartaglia on Morgan Stanley desk. So since then we have seen that it has just kept on growing, the statistical arbitrage. So just that, the difference being that it's actually a lot more statistical in nature as compared to when it started, where we were just looking at probably the returns and maybe the patterns as such. So in statistical arbitrage, what you do is, say, if we take a simple example of pairs trading, or so there are two instruments which are co-integrated is the right term, but you can say, for example, for the sake of discussion, just assume correlation, which might be more popular with most people. So if there are two instruments which are correlated and they have seen they are shown price action which proves convergence statistically, then you would like to buy one and sell the other one. So basically taking the offset positions to reduce your market exposure, and in the hopes of the spreads getting converged at some point of time in future. Right, so that's the basic underlying hypothesis for a statistical arbitrage strategy. So in this thing, what happens is, say for example, if I take up say gold and US dollar, for example. Now at times I might say that obviously it's not true always, you will have to check it statistically, but you might want to say that gold and US dollar, they are inversely proportional to each other. So that is, whenever gold is going up, we see that the dollar index is going down. Whenever the dollar index is going up, we see that the gold is going down. So that's a hypothesis. So first thing is that it's a strategy ideation stage where I'm proposing a strategy idea. The first thing to do is that I would like to check, I would like to prove that hypothesis, whether what I'm saying, does that make statistical significance or not. So how do I do that? Really, I'll just do a simple co-integration test, maybe a decupolar test, and see that whether what I'm saying, that these two things are co-integrated, is that true or not. If that is true, so I have proven my hypothesis, I have proven my strategy idea that yes, it does make sense statistically. So then I move to the next phase, that is, now I want to code, or now I want to model the strategy. So I would like to create something which would be which is mean reverting in nature, right? So I might have a different volatility profile for both. I might want to adjust them for the volatility. I might have to take the ratio or a multiplication or a spread of those things. I might want to do a regression on those between the both, and come up with some statistical parameters to see how we can have some remainder or some part which I can use as a mean reverting thing, so which is random in nature and which just reverts back to the mean over the period of time, right? So that modeling, you will be using statistical models to do that, and to do that, actually in real life, you will be using the financial computing tools as well. So most likely you will be using R or Python or maybe MATLAB, so which you will have to use and validate your so to create your model first, and then you will be validating your model, which would include backtesting the strategy, which will also include not just backtesting but also optimizing the performance. You might want to run some various HFT data analytical tools on that, on how to make sure that you're picking up the right parameters and you're not really curve fitting the whole model. So during that process, you have both financial computing tools as well as your statistical methodologies working for you. And then once you are done with that, you have some, now you have something which is back tested, you have something which is mean reverting in nature, and you are ready with the model. Now you want to go and implement it, right? So you will be going ahead and really buying gold on as one leg, and say buying or selling US dollar index on the other leg. Now the thing is that if I want to implement this, if I want to buy immediately, I would have to buy at the ask. If I have to sell immediately, I will have to sell at bid, which essentially means that I am paying the bid-ask spread, which is a big deal in case if your strategy is an intraday strategy, or even worse, if it's a high frequency trading strategy, then you can almost never afford to pay the bid-ask spread on both the legs. So what you will do is that, okay, then let me just pay on one of the legs. So I will quote on one of the legs at the bid to buy and ask to sell, and whenever I'm getting a fill, then I would go and cover in the other leg. So that's the most basic optimization that you can do. All right. Now the question is, which one do I quote with? So you can say that, okay, I would quote on the leg which has more, which has less liquidity, so that I can have more I would be saving more in terms of bid ask. Or you might want to say otherwise as well, that I would be quoting on the leg which has more liquidity, because there the probability of getting a fill would be much higher as compared to the leg which does not have too much liquidity, which is so far so good. But the issue is that for the cases where both have, to whichever philosophy you belong to, if you have both which has ample liquidity, in this case, like in this case, gold and US dollar index, you have ample liquidity and the similar bid-ask spread in terms of bips, then what will you do? So the idea would be that you would like to quote in the leg which is leading, because everything takes time. Whenever you're quoting, if you're quoting and you're getting a fill and then you're sending the order of the cover order on the other leg, then it is taking some time, maybe some microseconds, maybe some milliseconds, maybe something more, depending on where those two legs are, right? So for that, you will be taking the position first in the leading leg, so that you do not end up getting a slippage when you send your cover order. To do that, you would again be using statistics again to see which one is the leading one. So you can run a Granger causality test, some causality test you can run, and try to figure out which appears to be the leading leg at that point of time. So based on that, you will send the order in the leading leg and send the cover order in the lagging leg, by thereby mitigating your slippage, the possible slippage that you could have incurred if you were to send order in the lagging leg first instead. So that's how the whole strategy flow goes, right from the ideation to modeling to optimization to implementation. You actively use statistics, you actively use statistical tools, and then obviously when you are when we are talking about the latency and saving on the by means of leading and lagging legs. So statistics is one part. Then also you need to have a technology and the algorithmic trading platform, right? Algorithmic trading platform to make sure that you are reaching out in the right manner. So that's how all these three modules that you were seeing earlier, that's how they get connected, which is the primary modules that we have, be it quantitative trading strategies, statistics, and financial computing. That's how they're overlinked, and that's how they actually fit into the skill requirement that we have for the quantitative trading success recipe, which we have seen, and a lot of people who have taken benefit of that, which is to have a complete good understanding of statistics, financial computing, technology, and market microstructure, and the financial markets. So that's the key recipe. So that's about it from my side. Now we will be taking questions. So let me just open the questions from you. Those of you who have not yet posted any questions, please feel free to post your questions here. We will be happy to answer them now. All right, so there's a question from Nasir that what is the future of HFT in the Gulf states? So in the Gulf states, I think one of the exchanges, leading exchanges, which and the Gulf side is DGCX, Dubai Gold and Commodities Exchange, which has ample amount of liquidity from algorithmic trading. But yes, even right now we have not seen too much of algorithmic trading happening in the Gulf side, in the Middle East, but we do expect that it would be picking up there. And as we have seen in the Indian market context as well, as soon as it picks up, it starts picking up. It picks up really fast. It picks up really fast. These numbers that we were showing, 35 to 45% of algorithmic trading volumes being algorithmic in nature. It's not something which has taken 8 years. This was the case even in 2012, 2013. So probably within 4 years, those numbers were reached. And with the advent of further technology, we expect that that number would go even more in the Indian markets. And same thing we expect for the Middle East market. Close to Middle East, we have seen that Turkey, the Bursa Istanbul, that has been picking up on the algorithmic trading really fast. They have recently allowed certain aspects of algorithmic trading which were not allowed earlier, and they are now the volumes there are rising, and also the algorithmic trading participation is rising pretty quickly. We have a question from Kevin Mehta. What was the full form of CME, and with respect to latency arbitrage? I think the full form of CME is Chicago Mercantile Exchange, and SML with respect to latency arbitrage. I didn't get the question completely, Kevin. It would be great if you can elaborate on that a bit in your next query. Rajiv is asking, can you help with correct link where you got the NSE data for algos? Sure, I think I will ask the support or the sales team to get in touch with you. These are the numbers which exchanges release periodically. So for some of the exchanges like MCX, they release it on a daily basis or real time on a daily basis. Some exchanges provide on a less frequency as such. Then are you okay? Then we have question on, does the Naveed Mohsen has asked, does this course help us in trading, or does it also help us in working for these financial institutes? Yes, definitely. This is a practical oriented program which is focused towards working professionals. So if it does not help you in trading, or does not help you in getting inroads into the industry, then it's not doing its job. So definitely that is the focus, that it does help you in trading. And but I must tell you one thing, that the idea of this program is not to provide you with the algorithmic trading strategies or like the working trading strategies as such. We can very well do that, but that's not the idea, because what might work for you might not work for me, because we have different profiles, different trading orientation. We might have different infrastructure. We might have different risk profile. So that won't really help. And if we go and use the same trading strategy, everyone uses the same trading strategies. More important thing is to learn about what are the various trading strategy paradigms, how to come up with those trading strategies yourself, how to learn about the modeling, optimization, all those, and the implementation aspects of it. That's what is more important. And by the end of the program, we try to make sure that you know all those things, and you have a good understanding of that. Then we have a question from Pankaj. He says that he is from a commerce background, don't even have basic knowledge of technology, software engineering, but doing chartered accountancy right now. So Pankaj, I think what we normally do is that although we cover right from the basics in our program, everything, be it Python or be it statistics, we write, even in statistics we write right from mean, mode, median. What do we mean by that? What is standard deviation? But we do move to the advanced concepts. Say we will be moving pretty quickly to what the causality is, what the ARIMA gauge modeling, volatility estimation, all those things we moved really quickly. So if you do not have a previous understanding of the basics, we don't want you to be the expert in that, but if you don't have the understanding, then it might become difficult for you to extract the maximum value out of the program, which is our aim throughout the program, that you make sure that you extract the maximum value out of the program, extract the maximum of all the concepts that are being covered in the program. So what we normally do is that if you feel that you do not have sufficient background, then we provide you with the study links, which are obviously free of cost. So you can go through them, you can get an idea. We provide you with some of the web sessions that we have conducted earlier for your reference. So that gives you some idea about what to expect from the program, and also give you the basic understanding of the different modules which are involved in the program. So once you have the basic understanding, then obviously when you join in, it's not very difficult. And to give you an example, we had a few guys, one of the leading globally leading exchange, who didn't had any understanding of Python when he joined the program, but by the end of the program he was already creating quite complex strategies, creating and coding those strategies in various platforms on Python. So it's possible. It's not difficult, not really difficult, but you need to have some basic understanding, and that's why we had that 200 hours that we had given. So that's why for the self-study as well, in addition to the 100 hours that you do for the 100 hours that you do in the classroom contact. Rakesh is asking, how perfect is trading for living? Rakesh, we believe, to be honest, we believe that if you are trading, and if you are trading for living or trading to make money, either ways, you need to treat it as a business. You cannot treat it as a trading that, okay, I'm just buying and selling, and whatever the difference is, I'll be pocketing that. That's the ultimate. That's what ultimately happens, but that's not the idea, because you have to treat it as a business. Just like in a business, say, even if you are running a grocery store, you would be looking at a lot of things, which real estate or which area you're opening that store, and what kind of people come there, what kind of brands you will be keeping there, what kind of staff you will be having there, right? So all those various parameters are there which will define how successful your grocery store is likely to be. Similarly, in trading side, if in the trading business, you will be having a cost of credit as a parameter. You will be having people, what kind of people you have, what kind of technology you have, what kind of infrastructure you have access to, what kind of markets, all different kind of markets that you have access to. So all those things do make a lot of difference when you try to trade for a living, or when you start actually looking at trading as a business. And just doing that, what we have seen, just doing that increases the odds of your success by huge amounts. So I think there was a question by Sandeep, somebody who does not have a coding background. I think I have already answered that. Please let me know, Sandeep, in case if it is not answered yet. Then the couple Marwaha has asked, what is the future of algo trading for retail traders in India, because SEBI restricts the same and need one to be an AP. So this is something which we have seen in the past, where it's not like you cannot participate in as a retail in by doing algorithmic trading in India, but it's more to do with that it is really difficult to do HFT as a retail. You can do automated stuff, but you have to go through a broker. You cannot go directly to the exchange. So that limitation is there. But what we see is that if you're not looking as a retail, but more as an individual professional trader, then you can always connect with the broker, always reach out to him, and maybe put your strategies under his umbrella. So that can help you in getting the access for HFT or the direct market access as well. So Sebastian has asked a question: after completing the course, do you have online job offers for algorithmic trading? I'm not sure if I got the question correctly, but I guess you are referring to can you have online job offers, so like where you're working online, um, not as an employee probably, but there are certain brokers who can help you in having access by online access, because everything is remote anyways, especially for the global markets. So you, even if you want HFT access or if you want medium frequency access, that is possible. Yes. Um, is that the most obvious thing that you can that can be done? Probably not. Um, but yeah, so but we have been trying to expand our placement relationships beyond India and Singapore. But right now it's more focused towards India and Singapore. The opportunity is there, but we are in the process of getting more inroads into the other geographies as well, especially given that we have a fast-growing alumni base in other countries as well. Nikunj is asking what is the cost of setting up an algo desk which trades right from low latency to high latency trading. So I'm assuming you have meant low frequency to high frequency trading here, and I'm assuming that you are talking about from the Indian perspective. If you ignore the algorithmic trading platform cost and the human capital, as in personal cost, the people cost, in that case, probably it should be somewhere between the range of 10 to 15 million rupees, so 1 to 1.5 crore rupees, which is approximately about USD 200,000. So that's just an estimate. It obviously depends on a lot of things, depending on the scale that you plan to start, depending on the what all destinations you want to trade with, a lot of things actually. But yeah, that's a rough estimate that I can provide. Ketan is asking, in algo trading, mathematics and stats make huge difference, and even programming language to be learned or to be known. What if layman wants to do the program? So as I said, Ketan, we have had people who didn't have any mathematical or programming background, but came out in flying colors, and not just recently, but even people from like batches, say 4 years or 5 years ago, they are actually without any academic background in stats or technology. They have been able to land into jobs into algorithmic trading prop firms or hedge funds in the past. So it's possible. Obviously, it's not easier. It becomes much more easier if you have a background. But if you are willing to put in time and effort, then yes, the program is designed in a manner that you can pick up things fast. But if you don't have any understanding, then we make sure that you have some understanding before you join the program. Otherwise, it can become a challenge. Nikhil is asking, is a career in this field similar to prop trading role, where job security is very low and most prop traders are hired and fired at a relatively higher rate? Okay, so let's. If I go back to the slide where we had, I think this question was, yeah. So over here, if you see, these are a lot of different profiles which are there, and this is actual data. This is the, as of now, what we have. I just got that from the placement cell on our side. So this it's not like we only have prop trading roles or the only developer roles or nothing like that. It's always a mix. That's how it always remains. So it's there in financial markets. You are not incorrect in saying that the job security is relatively lower as compared to the other conventional fields, but obviously it's a higher risk for a higher reward, right? So the algorithmic trading or quantitative trading, it still remains one of the most one of the highest paying jobs in the industry. So obviously there is something which is called fat, which keeps on coming. Like in India right now, we have a e-commerce where people are getting a huge amount of pay packages in that domain. But that's a time, for the time being. Maybe if it continues, that's a different thing. But quantitative trading or the trading world in itself, so like Wall Street or Dalal Street or any other street in the world where the trading happens, as it has mostly been the domain where you are able to reap in huge benefits. So, but those benefits obviously comes at a slight cost. So, Nikhil, I hope that answers your question. Pankaj is asking this, is it more of technology? Not really. As I said, it's a mix of technology, stats, and trading strategies. So all three you need to have. Rajiv had asked that he thought that it was much lower for NSE, which is of course not true. It's been so. In fact, we had even created so QuantInsti had created the NCFM module for NSE. So both the complete module on algorithmic trading that was created in NCFM. That was created by QuantInsti for NSE, and these are all validated data. So yeah, that's how much it is there. Indranil is asking, what is the purpose of Python and algo trading when R has an upper hand in statistical data analytics? So you are right on spot, Indranil. There, yes, R has upper hand in terms of statistical data analytics, but Python has been taking over on that side a bit, but obviously it has not overtaken yet. But what we cover Python is from the perspective of the execution. So for the strategy implementation. So we cover R from the strategy modeling perspective, strategy optimization perspective, and for the strategy implementation, Python is the language which has been going up really fast. Having said that, it is possible to use the R language to connect with some of the brokers as well as some of the trading platforms. But Python is something which is used more, which is more popular as well as is growing much faster. Hiten Premji Bhadra is asking, algo trading need support of technical analysis? Not really. So it's basically technical analysis is so technical analysis, you have three parts in that, right? So one is your technical indicators, second is your technical, so charts and patterns, third is your waves, so like Elliott waves or other wave theories which are there. So technical indicators are essentially your formulas, so which you can very easily quote. So algo trading, you can do that. Patterns and patterns trading, that is also possible. So if you can think of it, you can create it in the because computer coding is nothing but logic, right? So is your algo, so is your human mind. So if you can think of it, it is possible to code it. It might be more difficult or it might be easier to code, but it is possible. So the charts and patterns, or that is also something that is possible. So are the waves. But most of the automated trading strategies, what people generally do is more on the lines of technical indicators. So I'm talking from the technical analyst perspective. Although in the program, in the EPAT program, we cover more from the quant trading perspective. So where you use more of statistics and mathematics rather than the charts and patterns. Ketan is asking, is there any special session conducted for maths and stats? It's a complete module, Ketan, where we have the complete module for mathematics and statistics. So it's there. Balbir Singh Rawat is asking, is NSE allowed fully algo trading or HFT? Yes, it is. Since April 2008, NSE had allowed, NSE BSC, or rather SEBI had allowed algorithmic trading in India. Who are really successful in generating that alpha? Sandeep is asking. I guess Sandeep, whoever is, they are not really going to tell unless it's unless you're coming up for an IPO like Virtu was planning to, Virtu Financial. So they had disclosed that out of, if I remember the numbers correctly, although the order is right, but about 1,238 days at the time of filing the report, out of 1238 days that they had traded, they were profitable on 1237 days. So yes, there are firms like Virtu which have been able to generate that alpha, but obviously it's those who are not planning to come for an IPO. I'm not sure if they would come up with the disclosure or disclose themselves. Do we need to learn coding like C++ first, or we can do in Python? Deepak has asked this question. So Deepak, yes. You can do it in Python. It's not C++. In fact, we do not cover C++ in the program because we understood that it was getting really difficult for the people without a programming background to learn C++ during the short span of time. But they are able to catch up on Python, so which is much easier language to pick up on, even if you don't have a programming experience, but definitely needs a lot of effort from your side. And plus, obviously, Python is taking up, as I said, it's coming up really fast. Rakesh is asking, are algo trading strategies designed mostly for scalping or small gains? Rakesh, this it's a good question that you have asked. So in algo trading is nothing but automating the trading, automating your trading. Now, you might have a low frequency strategy in which you are only taking, say, 4 trades in a day in the strategy, but you want to scale it up to probably you are running it on 5 or 10 stocks right now, but you want to scale it up to 500 stocks. So it might not be possible to do it manually. So that's where also algorithms can help you, and it's not necessary that you only need scalping or small gain strategies for implementing algorithmic trading, but it is helpful everywhere. A lot of fundamental traders, even they deploy a lot of factor models and do rigorous data crunching using automated systems or statistical tools, and then take up their positions. And even the funds who take were purely fundamental, say for fundamental based, and who does not have anything to do with algorithmic trading, ultimately their orders are executed through algorithmic trading execution strategies only. So it's all over there, and we cover most aspects of all these things in the program. Um, so Rohit is asking, could you give some examples of 2 months post-project work? So Rohit, it can be a strategy, say a statistical arbitrage strategy that you want to create. It can be a strategy, or it can be a business plan that you want to create, that I want to set up my own desk and I want to know each and every aspect of what are the things that I would need to focus on, I would need to learn on. So those things can be put into a plan, or it can be some other strategy, say dispersion trading strategy, or it can be a technology-oriented project in which you are planning to develop some technology for algorithmic trading. So you can pick up anything you want, but it has to be something which is linked to quantitative or algorithmic trading domain. Would a statistical major would be able to cope up with the curriculum? Indranil has asked. Oh, certainly, most certainly. In a statistical major, the people from the statistical background, they are there, and they have been able to do the program pretty well. So you can see in the statistics, the top 3 are mostly, if you can relate them to the statistical background: economics, statistics, computational finance. And I do not have the chart here, but huge amount of our alumni come from that background. The statistical, if you have understanding, and what normally we assume is that if you have done the statistical major, you might be familiar with something, say SAS or R or some language for the analysis, which really helps in the program. Then we have, other than interactive brokers, what else are there in program in India? Does it work in Zerodha's Nest platform? It might, I guess. Not sure, but the idea is, see, we tell you the select platforms. We try to cover that in the program. Once that is done, then obviously it's not too difficult to replicate it on other platforms as well. Especially if someone is offering you a Python bridge, then yes, definitely you can. We do have some broker linkages, broker partners who can help you as an individual trader, and also as if you're a broker, then there are a lot of vendors who should be able to help you after the program and also during the program. So we even try to get some sessions done from their side depending on what the batch requirements are. So we keep 1 to 3 sessions of 3 hours each for which are flexible. These are in addition to our core program, where we have some guest lectures coming up. So we had guest lectures coming in from Goldman Sachs, we had from Bursa Malaysia, we had even recently like from Quantopian itself. So all these different platforms, vendors, brokers, exchanges, market participants, we try to get them on board, and depending on what the requirements of the batch are and the profile of the batches, we conduct some additional guest lectures as well. Naresh is asking, what kind of returns does a typical algorithmic trader make? Well, it depends. We know algorithmic traders who are able to make thousands of percentages. We know algorithmic traders who have lost their shirt. So it totally depends. There's no typical answer for this. As I said, it's as much as a business. But yeah, I can tell you that the returns are relatively higher in algorithmic trading. Primary reason being it's opportunity driven, so you do not really take too much of market risk. If you're not taking too much of market risk, then it would not be, if you're not taking too much of market risk, then you tend to make more money, but the problem is in terms of scalability. So scalability as an individual level or even as a medium-sized prop level, the scalability is not really that big a concern, but you need to keep coming up with different strategy ideas and different paradigms of strategies to scale it up, because the opportunities in one particular strategy would be limited. So I knew a guy who used to have this strategy, and he used to run on one of the commodities market, where he would just trade on one lot, maybe paying for, like, maybe the margin is just few $1,000s, and he would actually generate few $1,000s in a day itself. So the returns, if you see, it would be really huge. But then the problem is that his strategy was scalable only for 1 or 2 lots. It was not scalable for, like, say 100 lots that you would see in a fund management business. So that's there. So returns are relatively higher generally, but scalability can be a concern depending on what kind of returns you have. So to give you further understanding, so the biggest of the hedge funds or the fund management houses would have hundreds of $billion under their assets under management, but biggest of the HFT prop shops, you won't have more than few $billion as assets under management. And that is also one of the reasons why most of the people in the HFT side or in the algorithmic trading side, they do not go into the fund management side. Thereby they will have to part away with 80% of their, say approximately 80% of their profits, but rather they try to build it on a prop basis. So yeah. What is the cost of the entire online course, So it's online, it's interactive, and it's live online. So Dexter has asked. So it's I think 4250 USD for the entire course, and then for Indian participants there is a separate fees, which is nearly about 200,000 rupees, inclusive of taxes. John Chan has asked, I have a question, what is the level of statistics skills required to have for this course? I would believe you need to understand the basics. If you know till correlation and what standard deviation is and what volatility models are, some basic understanding if you have, then I think you're good to start. But if you have some doubts at that level, then we definitely suggest that you go for some primers first and then join the program, because we do not want you to get stuck somewhere between the programs. So the idea is that as much as possible, we would like you to extract. So in fact, not as much as possible, but we definitely want you to extract the maximum value out of the program. So our team, our support team, our sales team, they always make sure that they assess you, and then only they move ahead. So in terms of, they would assess you and understand your requirements, understand your level, and then you would be given some study links if required, and then only we move ahead. Nitesh Kumar is asking about the job prospect. Major recruitment quant role is from premium institute like IIT and IIMs. How come your courses help in getting jobs for students from tier 2 or tier 3 colleges? Nitesh, we have people, we have alumni from all kind of backgrounds, as you can see here, be it academic background or be it occupational background. Obviously computational finance or engineering science, business management, stats, economics, these are not things which are often taught in the IITs or IIMs. There are some, but that's not the only one. So that's not the only institutes that we get the participants from, or we place our participants from into the various openings. So it's not limited. To answer your question, no, it's not limited for IIT or IIM graduates. But yes, ultimately, if whatever background that you have, so if you have some relevant experience or some relevant degree or premium college degree or whatever, so if you have that thing, then definitely it's one of the factors. It definitely helps, but that is definitely not the only factor. So that is there. Ultimately, if you know things, how practically things work, then it's not that difficult. Ultimately, you have to go, maybe resume shortlist, you will face some difficulty from the firms which prefer, say, top tier colleges. But once you have been shortlisted, just you, then after that, it's not really the college or whatever background you have does not really matter. What matters is how you demonstrate yourself. Okay. Hiten Premji Bhadra has asked, is this course available offline? Yes, it is. From Mumbai location, you can attend it in the classroom as well. Then we have, is there anything similar to Quantopia in India? Prabhu has asked. If not, any institutions which allow individuals to run out their own, which allows individuals to run their strategies on their platform. Yes, Prabhu, there are institutions, and you can connect to the different brokers who would be able to help you on that, as well as the vendors. So that's possible. As of now, there is nothing like Quantopian in India. No. Indranil has asked, does the candidate need to be an expert in algorithms and data structure to take the best out of the course? It would be preferred if you become the expert during the program itself. So if you have some basic understanding of the Python, we do cover the data structures and different algorithms in the course. So you need not be an expert to start with, but definitely if you make efforts, so course does allow you to become an expert during that domain. So obviously, programming is something which you learn by doing. So more time you spend doing it, a better expert you, or more likely you can be the expert. Varun is asking what happens after the volumes in India also hit to the global standard of 75% and risk in near to medium future, like local regulation or increase in cost of trading. Varun, it is business risk, or rather it's not the business risk, but the regulatory environment or the business environment which keeps on changing. There has been a lot of guidelines which SEBI has come up with for algorithmic trading. But it has only helped in cementing the algorithmic trading, or the cementing the market participation. So the regulators, especially from the Indian perspective, the regulators in India has been really good and really foresighted in terms of what exactly they should be doing and what are the things they should be controlling, and where they should allow market forces and where they should be keeping the regulations. So we do not see anything negative which coming in. Regulations by themselves are not really bad. We like to have regulations, but obviously if they're not clear enough regulations, that is what causes the pain in the market. But thankfully in India, especially in the algorithmic trading or the financial markets domain, from the trading perspective, it's not like that. So it's pretty all right. So we do not expect any major issues coming in. But often, even if there are any changes, it's more likely to bring more opportunities rather than anything else. Nitesh Kumar is asking how to get started. Actually, what is the cheapest way? So you can, as I said, that you can start with, say if you're looking at US equities, Quantopian, if in India or other markets, interactive brokers using Python. Then apart from that, there are other ways too which are possible, which we can definitely suggest on the case-by-case basis. What are your requirements exactly? What kind of strategies you want to trade? And there is something which is possible to make it happen in an affordable manner. So like in India, you have platforms like Symphony FinTech. They even conducted a webinar with us earlier this month. So they do have, so players like them, they do have a platform which is quite affordable, like few thousand rupees a month would be the cost, and it's not too difficult to get started on them. So they are cheap, and you can code your strategies there. You can automate your strategies and go live using various brokers. Sandeep is asking, is DMA allowed in India? Yes, since April 2008 it has been. What is the difference between HFT and algorithmic trading? Hiten Premji Bhadra has asked. Hiten, the difference between HFT and algorithmic trading is that HFT is a subset of algorithmic trading. HFT often is characterized by huge number of orders, so like typically hundreds of thousands of orders in a day, um, multiple orders per second, very small holding period. So like you will buy and sell probably in a matter of minutes to seconds, and at times in a matter of milliseconds. So that's what HFT is. Algo trading is whenever you are automating your execution. That would broadly classify into algorithmic trading. So Sebastian has confirmed that he was looking from the online job perspective only. Yes, so that's I have already answered, I hope, Sebastian. What is the average package provided after completing the course? We not like there's no surety as such. We do not provide with any placement guarantee. We give it on the best efforts basis. We definitely have helped dozens of our participants to so like most of the participants who were looking for a change or who were looking for a placement, we are proud to say that most of them we were able to place most of them. or able to help them while they were trying themselves and able to help them in the process. So that's there, but yeah, it's there's no placement guarantee that we provide. But average package for the Indian markets, we see openings from the range of 6 lakh per annum to 30 lakhs per annum. That's the typical range that we get. Then there are some certain head positions which we get that is obviously at a much higher level. So Ramesh had the similar question. I hope, Ramesh, I have answered that one as well. Rakesh has asked, in the ideal conditions, what is the rate of return annually on retail basis? In retail basis, whether it is possible. Depends on what kind of strategy you're targeting. Obviously, as a retail, you would not, probably in India at least, you would not be doing high frequency trading. You would not be focusing on over there or the arbitrage side. So given that, it would be a function of what kind of risk you're running in the system, the market risk that you're taking, the market exposure you're taking. So it would be based on that. But you can, typically it's higher than the conventional trading systems, or even at the desk level, we have seen the kind of returns that were made by conventional trading desks and the kind of returns that are made by the new age desk or the prop shops, more new age prop shops. It's significantly higher. Ramesh had asked again some question related to salary. I hope that I have answered, Ramesh. Let me know in case if you have further queries on that. Kevin has asked, what are the opportunities available post clearing LCFM algo module? Is it a base to EPAT? Kevin, certainly LCFM module, as I said, that it's something which we only created, and it covers the basics of algorithmic trading from the market perspective, strategy perspective, as well as technology, system architecture, and regulations perspective. So it's there. So it's definitely a good good thing to get the basics right. So yeah, definitely if you plan to go for it, definitely. Rohit was asking about the 2 examples of 2-month project. I think I have answered on that. Rohit, please let me know if there are any further confusion regarding the project. Rakesh is asking, who in India is the biggest player in the algo trading market making? Rakesh, there are a number of firms. I think there are about 15 to 20 major firms which are active in the market, and you do have some of the biggest names globally which are present in India, but obviously they have not scaled up that much as compared to the scale that they have in the global markets, primarily because of the kind of opportunity that India offers as overall market vis-a-vis, say, developed markets like Europe or US markets. Nasir Al-Boghian is asking, if I'm going to start my own HFT company in the Middle East, would this program help me? Do you have further program afterwards? As of now, we don't have any further programs afterwards. We do plan to launch a few more on especially on the self-paced learning side. But yes, I'm reasonably sure that if you want to start your own HFT company, this program would match your requirements, primarily because this is quite a comprehensive program, and if you're starting your own firm, you would be managing a lot of people and managing a lot of things, and the comprehensive of the program definitely helps you there, because you would be getting exposure to statistics, you would be getting exposure to the from the practical perspective, actually, from financial computing, trading platforms, quantitative trading strategies, business environment, and also through the project you can explore other areas as well. So that certainly helps in doing that. Indranil is asking, how well do the graduates of EPAT meet the demand of the industry? Indranil, they are there all across. So we have had people who after completing the program have been able to successfully join their desired profiles. Some people have moved from, say, back office to the front office on the algorithmic trading desk, and the globally leading algorithmic trading desks. There are people who we have seen who have set up their own desk after completing the program and actually making money on that. There have been technocrats, pure technocrats, who had their own technology firms in different parts of the world, and they were able to they were able to launch their trading divisions within their technology business as well. So there are all sort of people who have done this, and they have been doing well, I guess, in general. Deepak is asking what is the difference between MATLAB, Python, and R software. Which one is best for coding? Deepak, though you can do anything with each of these, so like both the strategy analysis as well as the strategy implementation, but generally MATLAB and R are used more for the strategy analysis part, that is modeling the strategy and optimizing it. Python or C++, they are used more from the strategy implementation part. Kevin is asking if I am independent trader using algo, then do I need to disclose my strategy to the exchange and pay some fees for using algorithms? I'm assuming you're talking about Indian markets. Yes, you have to. So if you want to automate your trading strategies, you would need to empanel them with the exchange. That's what the regulation is. But it's not like they will be taking away your IP. That is not how it happens. But yes, you have to take the approval from the exchange, and there is some fees, not too high, but there is some nominal fees which you will have to pay for using algorithms. All right, and okay, Deepak is asking, do we can prepare strategy like straddle, triangle, and butterfly easily in Python? Definitely, you can. You can. That shouldn't be really difficult, Deepak. How much is how much broker charge per algorithm trading, say per day, Rakesh? Totally depends on the broker. It can be anything. It's totally between you and the broker how you can negotiate and what kind of deal you can get. So it depends on your volumes, your expected volumes, all those things. Sandeep, you're asking for me to repeat, but since I'm going with the questions in a chronological order, it would be great if you can post your question again, so I would be able to repeat the answer. Varun is asking, how does the EPAT complement somebody who has done CQF? So CQF is something which is more from the quantitative finance perspective. EPAT is something which is focused more towards working professionals who want to learn more about the practical aspects of quantitative trading and algorithmic trading. So like CQF would have a small part which is on algorithmic trading, but other verticals which are focused on other modules which are focused on other things related to quantitative finance and includes a lot of understanding of the interest rate products and trading them, structuring them, trading them. So that is there, which is not there in EPAT. EPAT is more focused on non-interest rate products, but non-debt related products, but credit products like equity, commodities, FX, currency, futures, options. So all those things are covered in the EPAT and in much more minute details with a focus on trading implementation. Rohit is asking, when are the batches scheduled in Mumbai? So Rohit, the online and the offline module or the program delivery is totally integrated. So it's the start online and Mumbai also start at the same time and the same lecture. So it's the online classroom is completely integrated with the offline classroom. So I think the next batch is starting from 4th of June. Balbir is asking, can you mail the details about the course content? Sure, Balbir. I'm sure we would be doing that. So Ramesh is asking, from the fresher perspective, can we get minimum rupees 6 lakh package after this course for a fresher? All right, so that's the interesting question. So as a fresher, if you learn the things right and if you are able to demonstrate your skills well, then definitely this is generally on the lower side of the whole range. So as a fresher, yes, I believe you should be able to, but it depends on a lot of things. So we do not guarantee these things like how much money you would be able to make or how much what kind of profiles you will be getting. But the idea is that we work together with you on achieving what your objectives are. We try to list down all the objectives that you have from the program, both from the personal learning perspective as well as from the professional implementation perspective, and we try to achieve that along with you. So that's there, but there's no guarantee, of course, because it depends on a lot of things, what your background is, how well you cope up in the program, as in how much time you devote for learning it, how much you can demonstrate during the interviews and all. So those things are there. Okay. Sandeep is asking what my trading firm is making on an annual basis. So Sandeep, that's classified information. I'm afraid I cannot tell you that. But we are in business, so you can assume we are good. Shahz Mohammed is asking, what are the best ways to start understanding about algorithmic trading and usage of our Python strat from a beginner? What are the best ways to, yeah. So Shahz, I think we would be happy to send some of the links to you, so we can certainly do that, and you can start from there, which are obviously free open source links, but we have shortlisted them, and we have pick the ones which are good from the program perspective. So we'll share that with you, and I hope that would help. So yeah, so we'll be sharing sites and books on that. Rakesh is asking, the crux of being successful would be core strategy. Coding, I understand, can be done with the help of this program. How can this program help in developing a new strategy? So Rakesh, I think missed out on a thing here, and that is that if you look at the EPAT curriculum, this Venn diagram actually denotes how big that module is. So quantitative trading strategy is the biggest module. So it's not like we are only covering the coding side, but you will be learning a lot of different trading strategy paradigms, and not just learning about the ideation as in what are the different strategies, but also how to model them, how to implement them, how to test them, optimize them, all of that. So that's there. Then Varun is asking, how is the natural progression in profiles from a fresher to experienced person? Varun, it totally depends on what your end goals are, what your objectives are, because we have seen people who are 50, 55 and still full-time involved into the trading side and do not desire to move to the management side of business. There are some people who move to the management side at the very young age itself. Some people who move just on the risk, want to remain on the risk analytics side and have made tremendous career progression on that side. It totally depends on what your idea is, or what your objectives are. How much money would be required to set up one's own algorithmic trading firm? Sandeep, I hope I have answered that question. As I said, assuming if you're, I believe you're based in India, so if you're talking about the Indian markets, it depends what kind of algos you would be trading, whether you want to set up your own HFT firm or something which is more focused on, say, machine learning based trading strategies kind of firm, or medium frequency or low frequency firm. So it depends on that and what kind of markets you will be trading. But as a ballpark number, you can assume that if you're planning to set up a desk, um, excluding the algorithmic trading platform and human capital cost, uh, you can expect somewhere in the range of 1 crore rupees, which is approximately 150 to 200 to 50,000 USD. Kevin is asking, do you recommend any books, forums to get more knowledge in algorithmic trading as a whole? Sure, Kevin. There are a number of forums, and also we have our own QuantInsti forum, which is in the process of getting populated. But in the meantime, we have some really amazing blogs, which we have on our blog, QuantInsti blog, and also a lot of educational videos, which we have on our YouTube channel. So I think that can be definitely a very good start. It has helped a lot of people. In fact, it has helped some of the heads of biggest prop desks in India, as well as based in Singapore, who have got benefited out of that. So I guess it should be helpful for you. But yeah, if you are looking for any specific information, then please reach out to us offline, and we would be happy to help on that. Varun is asking, are there any internship opportunities with financial institutions? Yes, there are. But given the nature of business, it's not very popular because the IP is a big constraint here. So yeah, so it wouldn't be. It's there are not a lot of too much work which goes as under the internship thing. But on the research side, yes, there are some internship opportunities which keeps on coming. Sandeep is asking, in continuation to his earlier question on setting up in his own desk from algo development to infrastructure included. Yes, Sandeep, in the number that I had suggested, I had included that. Balbir Singh is asking, I know technical analysis and all the aspects of derivatives and good understanding of equity derivatives, hedging, call, puts. how it will help me for my future as quant strategist. So Balbir, I don't know how you are trading these strategies as of now, but assuming that you are deploying technical analysis tools, I'm sure that um, deploying quantitative trading tools and statistical tools will put some more logic and some more scientific insight into your trading methodology, and that should help in improving the probability of success. So ultimately, the idea is to improve the probability of success in your trading, right? So that's something that we also focus on for our participants, and I'm guessing that you should be able to have you should be able to have some assistance through that. Rakesh is asking, I'm basically engineer but in market for 25 years but not in finance background. Can I get some study links like maths to take off for EPAT? Sure, Rakesh. I think we'll share those links with you. That should help. But if you are engineer and you have been in market for 25 years, I think you should be having good profile for the quant and algorithmic trader. Balbir, yeah. All right. Sandeep is asking for the number. I think Sandeep, you can reach out to a team, and they would be happy to arrange the call with you. So not a problem. So I think we are always eager to assist. Varun is asking, you have your office in Singapore. Are your opportunities better out there, and do your placement cell help opportunities in Singapore? Varun, yes, we do help with the opportunities in Singapore, but they are relatively less given the size of the market there. So more opportunities we have seen in Mumbai, but yes, there are opportunities that we have seen that have come up from our Singapore side as well. And yeah, I think we have been able to assist a few participants there. But it's a smaller market, you have to understand that. So even though it's a developed market, but it's quite a small market as compared to what you have in other geographies. All right. Great. So I think I have run out of questions here. But if there are any other questions, I'm happy to answer them. Otherwise we can just be done for the day. So I'll probably wait for a few seconds before closing it down. All right, so so thank you everyone. Thanks for attending this seminar, for this session, and it was really nice interacting with all of you. You are a lovely audience, and I see so many good questions which came from your side. I'm hoping that I have answered most of your questions, but in case if there is anything which I have not answered, we would be happy to address that offline, and you can reach out to us, and we would be happy to help. So yeah, so have a lovely day, and there was one last question which has come up. What is the mindset for being successful? I think Varun, it's by Sandeep. I think Sandeep, it's you got just treat it as a business. I think that's my only advice that I normally give for most of the trader or audience. That just treat it as a business, and success would be much more easier to come compared to that. All right. Okay, so in case of any other queries, please feel free to reach out to us, and let us know if we can be of help to any one of you, irrespective of whether you want to join EPAT or not. But we would be happy to help as our target to make awareness as much as possible for our to all the participants across the globe. So maximum awareness about algorithmic trading. That's the motto. So all right. So please feel free to reach out to us, and thank you so much. Have a good day. Bye-bye.
Well, algorithmic trading requires you to merge two traditionally disjoint set of skills. One is finance, another is technology. So you need to merge skills in finance and technology to be able to do algorithmic trading. So you need to understand the markets, you need to understand big data statistics to be able to design your strategies. But once you have designed the strategies, you need to also understand technology to be able to automate your strategies. So therefore, that is where the QuantInsti's education programs come into place. So we train people about the entire gamut of operations and skills required to be able to be a successful algorithmic trader.